You're now watching episode 50 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to today's episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and managing partner at the Real Estate CPA. And before we get started, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. We have a big announcement coming out tomorrow, and we're only announcing it to folks that are in the Tax Smart Facebook group tomorrow. So make sure you join and watch out for that big announcement that's coming down the pipeline. Today's topic is all about bulletproofing your mileage log. So as a real estate investor, you're traveling back and forth between your deals and your rental properties. And every mile that you travel, you get a 56-cent tax deduction. So if you travel 10,000 business miles during the year, you get a $5,600 tax deduction, which is probably going to yield about $2,000 in actual tax savings. Helps to pay for the wear and tear on your vehicle. In order to claim deduction, you have to have a mileage log, and the mileage log must contain four things. The first is the amount of the expense. The second is the distance in miles. The third is the time and place of the trip, and the fourth is the business purpose of the trip. You must also show your business miles and your personal miles on that time log. So if you traveled 10,000 miles, 6,000 were business, 4,000 were personal, you need to put all of that on the time log. You need to differentiate between a business trip and a personal trip. But that last one is key. The business purpose of each trip. This is where people lose on IRS audits and in tax court because they don't document the business purpose for every single trip. There is a 2020 tax court case, Johnson versus Commissioner TC Memo 2020-79, where this exact thing happened. He had a lot of trips back and forth between his home and his business location, but all he was doing was logging the event, not the actual trip, but the event on his Microsoft Outlook calendar, and the IRS said, nope, you can't take the travel deduction because you didn't hit these four things: the amount of the expense, the distance in miles, the time and place of the trip, and the business purpose for the trip. And the tax court looked at the Outlook calendar and heard testimony from the taxpayer and still sided with the IRS, saying, yeah, unfortunately, because you didn't provide these four things, we can't grant you this mileage deduction. So the taxpayer lost out on taking that deduction. So I just want to emphasize that it's a very strict rule. You can't just do one of the things or three of the things. You have to do all four of these things. And again, that is documenting the amount of the expense, the distance in miles, the time and place of the trip, and the business purpose of every single trip. How do you do that? Well, most of our clients use Google Sheets because you can put it on your phone. It's a cloud-based application, so you can record it anywhere on the fly. If you don't like a spreadsheet, then I highly, highly, highly recommend that you use MileIQ. MileIQ will use location tracking to track your trips from start to finish. It'll document the total miles driven. It'll document the business expense. It'll document the time and place of the trip, but the one thing that it won't document is the business purpose of the trip. So you would have to go in there and type in the business purpose of the trip. You can make rules and stuff to automatically add the business purpose of the trip, but MileIQ is a really cool tool that meets all these mileage log requirements. So don't take your mileage log lightly, because if you get audited and you don't have all four of these things, you will get denied that mileage deduction. And then you'll either have to contest it or you'll have to go to tax court to continue fighting it. And then you'll just have to see if the tax court judge is having a good day or a bad day. So thanks a lot for watching this episode of the Tax Smart Daily. If you have any questions or if anything that I say resonates with you, drop us a comment below. I love engaging with our community. And follow us online. We've got a lot of links below to Facebook, LinkedIn, Twitter, all sorts of fun stuff. We'd love to have you as part of our larger community.